All right. Well, good morning, everyone. I think we're at our start time, so we'll go ahead and get started here this morning. Welcome. My name is Lauren Groff. I'm a partner and the not-for-profit and higher education service leader here at Sikich. I'm honored to welcome you to our final day of Sikich's 2024 Higher Education Forum. We're excited to kick things off this morning with two great sessions. First, we have Steve and Carrie that will lead us off with a session on internal audit. After the session, we'll take a short break and reconvene for our FASB update. Just a couple of reminders before I turn things over to Steve and Carrie. Let's cover a few housekeeping items. For CPE credits, we will be utilizing the Conferences IO platform. We will have a link on the slide right here in front of you, as well as that QR code that you can scan to gain access from your mobile device. We'll provide 6 codes today and throughout the sessions for the CPE credit. And additionally, the slide decks from today's presentations are available in the handout section of GoToWebinars. All right, so without further ado, let's cover our first code of the day. 594 for our first code of today. And with that, I am happy to turn things over to our first presenters of the day, Steve and Carrie.
Thanks, Lauren.
Thanks.
So Carrie and I will be presenting this morning. Really quick introduction on who we are. So my name is Steve Randall. I'm a partner with Sikich, and Carrie and I and our team comprise the governance, risk, and compliance practice for the firm. I live in Chicago, and I've been with the firm for only a little over a year. In my role with Sikich, I lead the internal audit and GRC practice, which allows me to work with great people like Carrie, while serving and advising phenomenal organizations and the people they employ. Before joining Sikich, I was a managing partner of a company called Vanya Global. It was a consulting firm specialized in internal audit and assisting companies with governance, risk management, and compliance. I founded the firm in 2007 with people who are passionate about helping others. And we were acquired by Sikich last year, which is another group of people passionate about helping others. Sikich provides a platform to spread the word about the importance of internal controls and the strategic role internal audit plays or could play in organizations. And I've been doing this for a really long time now, and I really look forward to our conversation this morning.
Okay. So good morning, everyone. It's great to be here with all of you today. My name is Carrie Urbanski. I am a director within the Sikich GRC internal audit practice. I was born and raised and still live in Chicago. I started my career many years ago at Deloitte in the external audit practice. For the past 20 plus some years, I have focused on all things Sarbanes-Oxley, internal controls, risk management, and internal audit. I've been at the firm for about 7 or 8 months now. I was previously internal audit director for a few different companies, 2 of which were publicly traded.
And I forgot the most important part. Carrie and I want to connect with you on LinkedIn, and that QR code in the top right is Carrie's LinkedIn, a link to Carrie's LinkedIn profile. So if you have your phones on, you need them out to do those QR codes. Take a picture of that link and connect with her. Mine was on the previous page, so we missed that, unfortunately.
So you could go back, or they're later on, right? So
it's later on in the presentation, so just be ready. If what I say today is interesting, you're like, oh, I should connect with this guy, in the last page there'll be the QR code. If you're like, wow, I don't need to see that guy ever again, just ignore the code. So connect with Carrie if you're so inclined. All right, let me advance here. So, all right, let's get on with the show. Over the last 2 days, you've learned about artificial intelligence, fundraising, and how to encourage charitable giving from donors, tax reporting, GASB updates, and Title IV funding. This morning, we're talking about independent assurance and the important role played by internal audit. Now, I gotta say, if that doesn't have you sitting on the edge of your seat, maybe you should change seats. That's a joke, of course, and it's, as you probably can tell from the 2 minutes ago, it's probably not the last time I make a bad joke. Carrie and I will do our best to share some of our knowledge in the most interesting and lighthearted way possible. If you're thinking, like I would be thinking, can you start, please? You're in luck, because here we go. Looking at the title, I'm glad I hear Carrie laughing. Looking at the title, you might be asking yourself, what does that mean? Well, let me break it down. Assurance. It refers to the degree of confidence that the stakeholders, so in your case, it would be the board of trustees or executives, faculty, students, donors, etc., have in the reliability, accuracy, and integrity of the financial and non-financial information, as well as the effectiveness of processes and internal processes and controls within the institution. Essentially, it is how much confidence do you have in your college or university in any capacity. It could be financials or compliance, safety and security of students and staff, data integrity, data security, any and all things you do within your college or university. Take a step back and look at independent. Independent is just as you would assume, someone free from a conflict of interest. It could be a third party like us, Sikich, or it could be someone internal to the institution. Combining the two, independent assurance, is where the magic happens. It's an internal or independent party providing assurance to the stakeholders that the institution is operating as expected, and that's exactly the role internal audit plays. Even more simply put, Ronald Reagan, the most influential internal auditor in history, coined the phrase trust but verify, and that's exactly what we do. Information is constantly flowing in and out of your institution, and you and your colleagues or your colleagues are handling and processing that information on a continual basis. Also, money, whether it's tuition or donations, grants, sponsorships, merchandise and ticket sales, it's constantly flowing in and out of your institution as well. And similarly, you and your colleagues are processing and accounting for those funds on a regular basis. So the question I have for you, and what I want you to consider this morning, what are you doing to protect and secure the flow of information and the flow of funds? It's a rhetorical question for now, but it's a question I believe you should be thinking about, especially this morning during the presentation and periodically throughout the day. If you spend some time considering what I call institutional defense mechanisms, you'll create a strategic shield that will allow you to focus your attention on things that matter most. This morning, we're going to tell you stories about mitigating risk. We'll do our best to make them interesting and compelling. And in doing so, we're specifically going to discuss 5 primary topics. Why you and everyone else in your institution is essential to the governance process. And by governance, we're referring to how you govern your operations, essentially how you manage risk in your organization. How risk management is important for every institution, regardless of size. We're going to talk about strategies to mitigate risk with an emphasis on internal controls. Internal controls are the mechanisms that enable things to happen as intended. Internal controls can be critical to any part of the institution. We'll then share some stories about common internal control deficiencies. And lastly, we're going to talk about ongoing management and monitoring of your internal controls. And the evaluation of these internal controls is the role internal audit fills. As Lauren said, we'll have some check-ins throughout the presentations, which are required for CPE credit. So keep your phone handy so you can click on that code. And then handy at the end so you can click on my LinkedIn QR code. Okay, now on to topic number 1, why you are essential to the governance process. Leadership, whether hired or appointed, sets the tone for the institution and is expected to promote and foster an ethical and responsible culture. This is what's called tone at the top. Leadership not only has to set the tone by what they say, they have to reinforce the tone by what they do. There are numerous stories about a university president losing his or her job because they crossed an integrity boundary. They were not walking the talk. While it starts at the top, governance is a responsibility that should be shared throughout your institution. For example, the head of accounting and finance sets the governance for accounting and financial reporting, playing a crucial role in identifying and managing financial risks. They're responsible for establishing robust financial controls and systems to safeguard assets and mitigate the risk of financial mismanagement or fraud. Employees and faculty also play a critical role in effective governance in several ways. Number one, by adhering to high ethical standards, also by complying with internal policies and procedures and external regulations. They also have a responsibility for and hopefully access to channels for reporting misconduct or unethical behavior. They should avoid situations that pose an obvious conflict of interest. And they have a significant role in shaping the culture and ethical tone. And lastly, they influence those stakeholder relationships I mentioned earlier through their professionalism, responsiveness, and commitment to service. All this to say, the actions and behavior of everyone collectively influences the institution's governance practices and its ability to build trust with stakeholders. The governance expectations should be documented, understood, and shared across your institution. All right, like I said, governance is everyone's responsibility, not just leadership, but everyone has a hand in it. You need to ensure socially responsible and ethical behavior. You need to implement appropriate systems and procedures to mitigate risk. You need to ensure the integrity of internal controls, technology, and information systems and financial reporting. You need to ensure disclosure controls and procedures are compliant with all relevant laws and regulations. You need to ensure compliance with all applicable legal and regulatory requirements. You need to ensure the principal operating risks are identified and managed, and not the least of which, you need to ensure the safety and well-being of students. A breakdown in any one of these could spell doom for your institution. So let's take care of our governance responsibilities so that when your college or university makes the news, it's because of the good deeds you do and the mission you serve, the awards you win, and the value you create. But if it were only that easy, because sometimes it probably feels as if you're pushing a boulder up a never-ending hill. You can have the greatest ideas, the biggest ambitions, but if you don't have the resources, it's nearly impossible to execute. And if you're like most places I've worked for or worked with, resources are not unlimited. You likely can't allocate the adequate funds to instantly make your vision a reality. People and organizations, specifically the nefarious ones, are constantly trying to bring you down and distract you from your mission. You're likely relying on dated technology, accumulating some technology debt, resulting in overly manual processes. And as far as internal controls go, you're probably great at rallying around a problem, but too many times the problem could have been or should have been avoided if someone would have just done the right thing at the right time. Now, we're not in the firefighting business unless, of course, you actually are in the firefighting business, but I don't think anybody on this call is. So putting out little fires everywhere, one big fire distracts you from your mission. And conducting triage in operations is time-consuming, wasting valuable resources that could be used to support your mission and objectives. And even with these challenges, and maybe because of them, your role in governance is critical, because if you don't, the result could be horrendous. You can't afford a 6 or 7 figure wire fraud, and I'm going to spend some time later to discuss this. Wire fraud schemes are happening every day to every type of organization. You can't afford a security breach. Like I said, villains are attacking 24/7. It isn't a matter of if you're targeted, it's a matter of when, and you better have good backup and recovery capabilities because you can't afford to be held hostage by ransomware. Got a number of organizations that we've worked with that have faced that same challenge. You're definitely storing confidential data. I mean, you're a college and university, so you can't afford a leak of PII. You can't afford to be shut down because of a disaster, an accident, or act of God, or God forbid, a pandemic. You can't afford the loss of resources or funds due to mistakes, theft, or fraud. You can't afford accounting errors to impact your funding sources or regulatory responsibilities. And God forbid anything happen to a student, faculty member, or staff. But no matter how well-intentioned you are, villains are out there trying to undermine your stability. They're dressed in normal clothes, doing normal things until they're not. What's showing on the screen are recent examples I pulled from Google. These are impacted institutions of all shapes and sizes. Some might look familiar to yours. Unfortunately, these are not the only examples. This slide could have gone on for a very long time, but for the sake of time, I limited the list. As you can see, some of these listed are cyber attacks and data breaches. Did you know that numerous studies indicate that human error is behind most data breaches? while a malicious actor may instigate, it's human error that opens the door. And it's not just limited to cyber attacks. Many problems we find are due to human error. And even when everything is seemingly running smoothly, it can be hard to consider and plan for things going wrong. But as we showed on the previous slide, bad things can happen at any time, anywhere. Most of the problems we observe are not perpetrated by someone acting maliciously. On the contrary, it's a good employee, a loyal employee, a faithful employee, someone trying to do the right thing for their institution, but they just make a mistake. Sometimes it's a major mistake, but it's still just a mistake, and everybody makes them. The busier we get, the more stress we're under, the more likely we are to make them. We need to have mechanisms in place to stop these errors. Again, we need to have mechanisms in place to stop these errors. And then we need to independently review these mechanisms to make sure they're effective. Mechanisms equals internal controls. Independently reviewing equals internal audit. And with that, I'm going to pass it over to Carrie.
Okay, thanks, Steve.
You're welcome.
So similar to a lot of things in life, it starts with us as individuals, and I think most of us can relate to that. But obviously, when working for an academic institution, there is a significant amount of responsibility. And like Steve mentioned, nobody wants to end up in the news for the wrong reasons if you want to end up on the news for the right reasons. But all of you are held to the highest ethical standards. And for governance and enterprise risk management strategies to work, you as individuals must be a part of that. Otherwise, they won't be effective. The efforts will fail. Moving on to the next slide, which is the second code word out of 6, and the code number is 734. So the second code, passcode, is 734. We'll wait a few more seconds on that so everyone can get a chance to get their phones out.
I see it's been populated in the notes. So give everybody a second as they're scrambling for the phone and opening up their camera.
And then if they don't get it, maybe writing it down, 734, I'm not sure if that'll.
Yeah, it's in the chat.
Okay.
There you go.
Okay. So all organizations, no matter the size, the industry, whether it's private, nonprofit, a government agency, an academic institution, have risk management strategies. Some are informal and some are more developed than others. So as we go through this today, the questions we want you to be thinking about are, what are your risk management strategies? Not only if those strategies can identify and mitigate risks, but are those strategies designed and operating effectively? And we'll talk a bit about this because of course they're important to be designed, but really it's important to ensure that they're operating as you intend. If your assessment is solely based on your feelings or just a feeling or your trust in the individuals performing tasks, there are plenty of stories where the trust has broken down or even failed. You may want to consider testing those strategies to ensure that they are appropriate and operating as you intended. If you don't have any form of risk management strategies, well, what can happen? Quite frankly, fraud. And Steve showed the slide of various different headlines of real life frauds that have happened at real life institutions that have taken place over the past several years. Fraud happens at both large and small organizations, private, public, government, nonprofit. It truly does not discriminate. If you do have formal risk management strategies, that's great. You're effectively improving your chances of identifying risks coming up in your organization. And when you identify the risk, you can effectively mitigate them. Most organizations employ the 3 lines of defense model, which we will go through in the next few slides.
So I saw somewhere that they were calling, if fraud was called in industry, or I guess they're calling fraud in industry. But if you aggregate the dollars from fraud, it would be a Fortune 500 company.
Oh my.
Oh my, right.
So the 3 lines of defense model, it facilitates strong governance and risk management. Within this model, all the roles within the 3 lines are working together collectively, and they contribute to the creation and protection of value, which of course we all want, right? That's a win-win for everyone. Depending on the size, complexity, and staffing of your institution, you may have stronger first lines of defense and less so on the second and third lines. Or perhaps in smaller organizations, the first and second lines are performed by people wearing multiple hats with multiple responsibilities, and there is very little difference between the first and second lines. Maybe the lines are a bit more blurred. And we'll go through these lines of defense in more detail in the coming slides. Next slide. Okay. So the first line of defense is your employees and what they're doing in their day-to-day jobs. Hopefully, they're following established and documented policies and procedures, or at a minimum, they're following procedures that they were taught on the job related to what they need to accomplish. Policies and procedures, whether defined or informal, preferably they're defined, they help guide employees in their jobs and how they're supposed to perform tasks. Included within those policies and procedures or elsewhere in the institution might be internal controls. And we'll talk more about internal controls and how they're defined on the next slide. But when internal controls are designed and defined and operating effectively, they help protect the organization. If there are weaknesses or cracks in this first line of defense, which this line is truly foundational, it becomes harder to catch issues. So there's an increased chance of fraud and risks you're not aware of coming to the surface and causing a bigger issue than there needs to be. So as I mentioned, let's define internal controls. So the Institute of Internal Auditors, which is the governing body for the internal audit profession, and they're kind of like what the AICPA is to accountants, but exclusively dedicated to the internal audit profession. The IIA sets the standards all internal auditors should conform to. The IIA's definition of internal controls is they are policies and procedures implemented by an organization to ensure their financial reports are reliable, operations are efficient, and activities are compliant with applicable laws and regulations. Internal controls are essential to good governance. They should be documented in procedures, understood by employees, and reviewed by management and institution leadership. It's not a one and done. It's not just document them and send them out. They need to. It's a cyclical thing and needs to be throughout the organization, including leadership. Also, they should be tested to ensure they are effective. We talked a little bit about testing, but we'll talk some more about the importance of testing internal controls. Okay, so the second line of defense, as discussed earlier, could be the same individuals as the first line of defense. This might be the case for lean organizations. For other organizations, there might be separate functions or groups. So whether you have a full ERM group or full-blown ERM program, or you just regularly sit with your teams to discuss risks and how to mitigate them, it truly does not matter. The important thing is that it's being done. Sitting around a table discussing what risks you should be considering in the coming year and how you should address them is a mitigation strategy, and this can be applied at smaller organizations. For some risks, when talking about the second line of defense, it could be an outsourced risk mitigation strategy. For instance, you might have outside counsel, or you could have an insurance broker for any insurable risks. Identifying, understanding, and then applying a mitigation strategy are the important things. If you're not in the process of identifying risks, you won't be able to determine how to remediate issues or apply a risk mitigation strategy to them. And similar to the first line of defense, if risks are not identified or there are weaknesses in the second line of defense, then the chances of those risks occurring or you being unprepared for identified risks increases.
So I want to back up real quick, Carrie, if I can interrupt and
Sure.
mention insurable risks. So some risks, the financial impact of a risk happening can be insured. For example, slip and fall. You know, you've got sidewalks on your campus, I assume, if they get icy like they do up here in the north, slip and fall, you have insurance that can cover that. But you also want to have a maintenance team out there salting the sidewalks. You can have cyber insurance, which protects you in case there's a breach, and it covers the damages from lawsuits and whatnot. but it doesn't prevent the breach. You need to have mechanisms in place, that security mechanisms in place to prevent the breach in the first place.
So talking a little about preventive controls and things like that ties in. Okay, so moving on to, so for most, we're finding that for most private, government, academic, smaller organizations, this is the most neglected line of defense. The third line of defense is independent assurance, which Steve had talked about earlier. It establishes accountability within the organization. It is important that individuals within the organization or the institution know that someone will be looking to ensure that things are done appropriately. So when we do internal audits, or we are the internal audit outsourced function for an institution, we conduct risk assessments. We look at the design of internal controls, and we test the operating effectiveness of those controls. We don't just rely on the fact that controls may be done and that control owners are performing them. We trust, but we verify, and we verify this through testing. Unfortunately, most smaller institutions do not have a third line of defense, and they can benefit greatly from doing periodic general internal controls reviews. We have done these for several organizations. We come in, oftentimes this is done remote when I say we come in. We review controls over a wide range of processes and give our assessment related to the internal control design and whether they're operating as intended. This gives some assurance to the leadership team, and again, establishes accountability within the organization. If people within the organization know that, maybe their boss is really busy and not maybe taking a close enough look, but that someone independent will be coming in, that's definitely a good thing. If you don't have a third line of defense, how do you really know what you've designed is truly functioning? And if there were changes in, say, people, happens all the time, right? Changes in processes, technology, what happens to the design? Has it morphed into something that you never intended or don't recognize? Again, there's a potential risk that controls may not be working, and if nobody is looking, you may not know until it's too late.
So why are controls needed? Really just to make sure things happen as intended. Carrie and I are sitting in Illinois, and I actually live down the street from DePaul University. I didn't look at the attendee list to see if anybody from DePaul is on the call, but one of the accounting professors at DePaul is Kelly Richmond Pope. Kelly produced a documentary called All the Queen's Horses, and I'm assuming many of you have probably heard of it, but if you've not, look it up. It's called All the Queen's Horses. It's the story of a small town of Dixon, Illinois, which also happens to be Ronald Reagan's birthplace. You remember him, the greatest internal auditor ever, the trust but verify guy. Anyway, Dixon was a victim of the largest municipal fraud in US history. The villain or person who perpetrated the fraud was a long-standing and trusted employee, and the hero was a soft-spoken, loyal employee who simply asked one question. She had the mechanism right in place to ask questions, and anyway, it's quite a story. All the Queen's Horses. For those who are interested, I think it's on Amazon Prime. If not, it's on Netflix. It's quite a story, and Kelly Richmond Pope does a fantastic job with the documentary. It's like an hour long, so it's if you've not seen it, I recommend going and doing that. Anyway, so far we've explained the importance of governance and the responsibility that is shared across your institution. We've shown some scary things that can happen in the absence of governance. Carrie has explained the three lines of defense of risk management and introduced the importance of internal audit. I thought it'd be important to take a slightly deeper dive into internal audit by walking through a sample internal audit charter. An internal audit charter is a formal document that defines the purpose, authority, and responsibility of an institution's internal audit functions. It serves as a foundational document that outlines the key elements and principles governing the internal audit activity. The first section here is purpose and authority. It's always purpose and authority, providing an overview of the internal audit for your college or university. The purpose of internal audit is to provide an independent appraisal of risk management, internal control, and governance processes, and it should operate under the authority of the Board of Trustees. You may be asking yourself, why the Board of Trustees? Well, to assure it's operating independently of management influence or interference when it performs its duties. There's that word again, independent. Organizations that do not operate internal audit in a manner of an independent manner, create an unauditable departments. And I'll give you a for instance. I had a client who wouldn't audit the billing department because of the influence the billing department had over the head of internal audit. It's a long story, but there was significant influence. Billing, however, was noted as a high-risk area by many of the executives, but it was never part of the internal audit plan. It was never looked at from an internal audit project perspective because of the influence the head of billing had. In this case, internal audit was not independent. They were not fulfilling their obligation to the institution. As we've discussed, internal audit evaluates the adequacy and effectiveness of governance, risk management, and internal control processes in all areas of the institution. So I ask you to take a minute here and think about your college or your university. What would you say is your top risk? You can write it down if you want, or you just think about it in your head. How much time, how much money, how many resources do you invest in mitigating the risk? Has anyone independently evaluated the risk mitigation procedures? If not, why not? Remember, the greatest internal auditor ever suggested that you should trust but verify. Verify doesn't demonstrate distrust in management. Probably say that again. Verify doesn't demonstrate distrust in management. It demonstrates to your stakeholders that you take the risk seriously. All right, there's one thing you should know about internal auditors. We love risk assessments, right, Carrie?
Yes.
Yes, we love them. Almost everything we do includes a risk assessment in one form or another. One of the primary uses of a risk assessment is to conduct it across the institution to identify key focus areas for internal audit. The result of this risk assessment is a risk-based internal audit plan. Each project will evaluate the design and operating effectiveness of internal controls. Those projects are narrowly focused on a specific area within the institution. And I think we're going to discuss some here shortly. Internal audit will also review the effectiveness of the compliance program, assess the reliability of financial and operational information, provide recommendations for improvement, and help promote the ethical culture within your institution. And bear with me a second, I got a text just as this thing was starting. It was from the legal counsel of the organization I talked about, the billing department. And he said, do you have any high-level materials on why it's a best practice to do an enterprise risk assessment? I said, I'll get it to you later.
You know what, one question I just thought of, Steve, before we even move on, because maybe people know the difference between internal and external audit. So maybe you could talk a little bit about that. Maybe
I could talk. You're asking me to ad lib here? The difference between internal audit and external audit.
In case people are thinking, oh, my financials are audited every year.
Absolutely.
I don't have to worry about any of this stuff. They're covering it.
Right. I'm sure that everybody on this call, and you're producing your financials, it's getting audited by an accounting firm, like could be Sikich. You're on this call from Sikich, so I'm assuming some of you have a relationship with our firm. Again, it's a great firm with passionate people interested in helping others. Anyway, so the validation of your financial statements is the external auditor. They will do tests to make sure that your numbers are accurate. They rely a little bit on the design of internal controls, but their testing is looking deep into the transactions and make sure that what you're reporting is accurate. Internal audit, on the other hand, is looking at your processes to make sure that there's adequate risk mitigation strategies so that if it's financial, your process allows you to produce accurate financial statements. Internal audit, while we want you to have accurate financial statements, that's not what we're looking at. We're looking at the processes that produce the financials, or we're looking at the processes that secure your institution from a cyber threat, or we're looking at the operational procedures. Like you say you salt your sidewalks and your roads. Do you? Can you demonstrate that you do that? So we're looking at the process and how you control and mitigate risk, where the external audit is looking at, are your financial statements accurate, and can we sign off on our opinion that says it is. Does that answer, Carrie?
Yeah, and looking at processes and internal controls, as we talked about earlier when defining.
Wow, scare me like that. Ask me to wing something.
Please, you're a pro.
All right, so now we're going to share some internal control deficiencies. Oftentimes, we get called in after something breaks so we can assist with triage. Essentially, we're picking up the pieces after something bad happens and figuring out root causes. Other times, we're asked to proactively help so that things don't break in the first place, helping improve the internal controls, the mechanisms that mitigate risk, right? These will be those stories. The goal is to have you learn from these and apply the lessons from your or for your to your institution.
And I feel like we talk a bit about bad stuff in this presentation, but I promise we end on a positive. We scare people with headlines, and then but we talk through the good things with the 3 lines of defense, and we talk again, not to scare, but to educate and help take back to your institution. So going through some of these deficiencies, common deficiencies. So one of the best ways to protect yourself is also one of the most common deficiencies that we see, which is segregation of duties. This means that one single person should not have complete access to a process without another person being involved in this process. And this is very important. We cannot emphasize this enough for all organizations, no matter the size, the type of organization. Some examples of conflicting duties are the same person is responsible for both preparing customer bills and collecting payments. So the person who handles billing could potentially manipulate customer accounts or misappropriate funds without detection. Or the person responsible for recording transactions in the accounting system also reconciles the bank statement. This lack of segregation of duties means there's less oversight, and errors or irregularities in recording transactions may go unnoticed. SOD can be difficult to achieve in smaller organizations. We recognize this. There's not limitless amount of people or resources. So again, we know that segregation of duties is difficult in smaller organizations. So it is important to be creative on how to achieve this. If you're struggling with this, because maybe you have a smaller organization, we've helped countless organizations with this challenge, or institutions, and we can help. Account recs is another. Go.
Wait, yep. Let me interrupt. Sorry.
Sure.
I'm trying to be cognizant of time so we don't run out. We've got an example for this. It's an example of multiple control failures or control risks, but I'm going to use it here rather than later, and I'll revisit it later here in the next page, I think. A secondary education institution, really highly respected, not small but not large. Their controller has, I think, 4 people in the accounting and finance function. He's responsible for reviewing everything and obviously putting together the financials. He has, by design, carte blanche access to all the systems. So everything that Carrie just mentioned he can do. So he has a significant segregation of duties issue, which is understood by the organization, accepted, and just there's checks and balances on him periodically. Well, they don't have class in the summer, and so that's when he takes his vacation, but it's not that business stops in the summer. So when he left on his vacation, I think it was a 2-week vacation, he assigned all his user access to one of his accounting staff members, which is fine, right? They have to get the job done. The problem is when he came back from his vacation, they didn't think to shut off all that access. So not only is there a significant segregation of duties issue with this lower level employee having access to everything, it was really forgotten about and unknown. Nothing bad happened, fortunately, but it went that way for, I think, 1.5 years until we went in there and helped them identify this unknown issue and help them fix it. Carrie, go ahead.
Sure. So account recs, another common deficiency we see. Institutions hopefully are performing reconciliations in a timely manner and investigating age transactions, large or unusual transactions, any differences, and of course, performing an independent review. It's one thing to be doing the account recs, but it's also important to have the independent review. Account recs are controls to monitor and hopefully catch items that may be indicative of breakdowns in your processes. So they're more of monitoring controls, I'll say, because they can identify issues, breakdowns, and other areas within the organization, other areas of the process. Cash is an obvious area. You want good segregation of duties. Also, an important task related to cash is at least annually reviewing the banking authorities. I've seen situations where previous employees who have long since left an organization still have banking authority. You don't want this. It's a housekeeping thing. Just clean it up, take care of it. Of course, it's important to have tight controls over cash, and that it's not within one individual's purview is critical for obvious reasons. Vendor setup and payments is another area we see many deficiencies, and you want to ensure these responsibilities are segregated.
So I've heard multiple stories dating back really probably 24 months now. And we've been called in to help organizations that have been victimized by a payment fraud scheme. It's pretty well known by this point. In multiple cases, it was a vendor that was hacked, and they sat on the hacker, the nefarious party, sat and monitored the vendor's activities. And when an invoice was submitted that was of substantial size, the hacker intercepted that and changed the invoice, adding different banking information for payments. In some cases, verification procedures from the organization that received the invoice were non-existent. In other stories, procedures were in place, they just weren't followed. In a specific story, there were procedures, and the victim only communicated with the villain, who they thought it was the supplier, communicated via email, which is a red flag if you're only communicating through email, because it was the fake email. And while they disguised it, there was some differences in the email address that could have been caught. The victim, my client, asked for a bank letter. It was an international bank, and they asked it directly to the perpetrator, and the perpetrator, of course, provided them a phony letter from the bank validating the account. That request for the bank letter should have gone to the bank, not to the perpetrator, not to the supplier. Even if the supplier had legitimately changed bank accounts, that valid verification should have gone to the bank. This case resulted in a $325,000 fraudulent wire payment that was unrecoverable. The really, really sad part about this is that we had done an audit for them 2 years prior to this and identified weaknesses in internal controls, weaknesses in their procedures. So they knew they had weaknesses. For 2 years, they knew they had weaknesses, and they did nothing about it. And it cost them, at that point, $325,000, and who knows if there's any other errors that happened because of it. Next slide.
Okay. So more deficiencies, more issues, more bad stuff. So expense reimbursements. With expense reporting processes, I think most organizations have seen something related to this. People can be very creative. We've seen people purchase a China set, put it through as a meal expense, because they're going to be eating their meals on their new China set that they bought in Japan. But the receipt was in Japanese and didn't think that somebody would be able to read the language. Again, people get creative, so watch out. Payroll, making sure there are controls around new hires and changes in payroll, very important. We saw a very large retail pharmacy store that caught its managers in delaying the termination date for its employees in the system so that they could take the last paycheck, cash it at a currency exchange, grocery store, and any other variety of different methods to cash the checks.
I had a call 6 weeks ago, I think now, from a really reputable, important not-for-profit. There was an error on payroll with the decimal places. An employee got paid 100 times their normal salary for that pay period. It wasn't caught. Employee's no longer around. They're trying to pull it back, and they're gone. So
wait, so like the person quit then?
I think the person was actually on leave.
Oh my God.
Which compounds it. So that's how the error happened, because they were on leave and they had to recalculate and figure stuff out. And it was a one-person payroll show as they're entering in information. There was no review. They reconcile at the end of the month. No approvals. So yeah, now we're going to come in and help them redesign internal controls so that something like this doesn't happen again. But really, for this case, it would be a review and a confirmation. So yeah, I mean, you said there's bad news. These are not bad news. These are all things that we want you to be aware of ahead of time so it doesn't happen to your organization.
Exactly. It's to educate so that you can go back and make these changes in your organization. Okay. So policies and procedures that we've talked about, general policies and procedures. We didn't talk at a higher level the importance of, say, a conflict of interest policy, a whistleblower policy, as well as a whistleblower program. If implemented properly, whistleblower programs allow employees to report issues or potential issues anonymously. So it's another way to become aware of items and gives people the comfort that they can do so anonymously. As far as the final item on here, most of what we've talked about is on the finance side of the house, but there are a lot of controls and issues that come up within IT. Steve has mentioned cybersecurity, but in small IT departments, you can have a lot of responsibilities within very few individuals. Or some of those individuals may have what's called privileged user access, essentially giving them the keys to the kingdom. They can make any change within the system for any data without anyone being able to see it. One of our clients was a very fast-growing technology company, and in their efforts to make sure that they were addressing the questions from the business in a timely manner, they gave several of their IT individuals privileged user access. Luckily, thankfully, no issues were identified, but the ability and the opportunity were there to be able to do anything. And I've actually seen where it was a newly acquired business, and we were a publicly traded company that I was at, and they had to be brought into scope quickly for SOX purposes. When they implemented their ERP system, they had given a number of people privileged user admin access. Very scary situation, very high risk. So just a lot to explain there. But
yeah, again, I've got a couple more. So we've got a fairly large, reputable university that we work with, and we were looking at doing an internal audit of their information security. And I will tell you this, they are so buttoned up. Their information security function is top notch. I would give them really high marks. From the onboarding of new technologies and new vendors, to the monitoring of them, to requiring those third parties, the cloud providers, whatnot, to demonstrate that they have appropriate controls in place. So they are I would say world class as far as their information security practices. And then I asked a question. Deans of universities are usually fairly independent. Do deans have the ability to pay for and bring into their college applications? They're like, well, of course they can. Okay, so what do we do to secure them? Well, we don't. That's not part of our responsibility. I'm like, well, you do an awesome job at like the corporate security functions, but you've got major. So if a dean is doing some clinical research on something, and they get an application, and in that application it has people's names and maybe their social security number, but maybe some health history, there's no monitoring of that. So while they're world class, there's one thing they completely are missing some of their bigger risks, what I thought were bigger risks to the institution. And going back to that secondary education group, we talked about segregation of duties where the accounting staff had access to everything and the duties weren't segregated. Well, that wouldn't have been that big of an issue because it was only temporary, but it wasn't temporary. They had user access issues. So when that controller came back from his vacation, they should have shut off that accounting staff person's access, and they didn't. Not that that's necessarily bad in and of itself. It is bad, but the worst thing is it was a year and a half later that we identified it. There should be a mechanism in place for someone to review user access at your organization. Who has access to what? Do they need it? Right? And that was never done. Skimming through my notes to see if there's anything else I wanted to add here. Another organization, they have a whistleblower hotline. Someone called the hotline, actually emailed the hotline anonymously and said they're concerned about the revenue recognition that this division within this organization was intentionally and improperly recognizing revenue to make their financials look better so that people could get a higher bonus. The serious allegation, regardless of what type of organization it is. So we were called in to execute some agreed upon procedures. We dug in and dug in and dug in, evaluated their procedures, evaluated their control systems, tested to make sure those control systems were effective. And the good news is that it was a false allegation. It wasn't an allegation we could prove with our testing, and we did a lot of testing. So the allegation proved to be false, but it shows, I guess, an example of if you have a robust system of internal controls and you can rely upon them, these bad things won't happen. Another code word. So we'll give you a second to get your own, take a picture if you need to, and enter the code 938. And moderator.
Advanced. Oh, there we go. Okay. Yep.
Oh, my internet must be slower. Sorry. But moderator 938. There it is. So we should have the Final Jeopardy music playing right now.
Right, and it says 3 of 6. Where?
Yeah, because there's another session after ours.
That's why. Okay, just want to make sure. I'm like, oh boy.
Oh boy. All right, we'll carry forward. So yeah.
Go ahead.
938, yes, 938 in the notes. So what can you do? So key takeaways here. You should set out to do the things that will make your institution more stable. Yeah, that's kind of the duh statement, but so first is setting a strong tone at the top that motivates and encourages everyone within your institution to be responsible and ethical. I mean, that even includes students, really, you know, their use of technology on campus, their behaviors. I got 2 college students, and anyway, determine 2 children. 2 of my children are college students. So set a strong tone that motivates and encourages everyone involved in your institution to be responsible and ethical. Determine what the highest risks are that you face. Do that risk assessment. Sit around a room, talk to other people in other functions, and make sure you mitigate the highest risk first. Take a look at your lines of defense and how you divide the responsibility for risk management. Dust off your and evaluate your policies and procedures. Update them as needed. Many organizations, not saying that yours is one, but many of them have documented policies and procedures that haven't been looked at since 2010. Lots have happened since 2010. So grab them, pass them through the organization, make sure the owners of those procedures review them and validate that they're still applicable. If you don't have them, create them. And then don't be afraid to ask for help if you need it, right? If you don't have them, it's kind of an onerous task. There are organizations like ours that can help you. There are libraries that we reference that provide a really great starting point. Finally, don't forget about the third line of defense. If you're a large university or you're from a large university, you probably have an internal audit department. Do me a huge favor, support them in all their efforts. they're trying to serve the best interest of the university, while, you know, sometimes it can be difficult or tedious to provide them the information they need. I ask you to please support them. If you don't have an internal audit department, then take the necessary steps to periodically review your internal controls. Carrie mentioned a few minutes ago about you can start with a general internal controls assessment. She explained what it is. I'll do so again. It's an evaluation of the internal control design and operating effectiveness over general risk areas like revenue, fixed assets, payroll, treasury, user access, data security, physical security, and others. The questions you're asking is, how are you safeguarding assets and preventing fraud? How are you creating a safe environment? How we do this, as Carrie mentioned, we walk through every area and assess the risk and validate the internal control effectiveness. We'll work with management to resolve any of the risk issues that arise. We'll help them put together plans in place to mitigate the risk. And then we summarize it all in a report, which essentially creates a punch list of management actions that someone else in the university or college can review periodically and knock out the checklist of activities that need to get done. Essentially, it's to say, again, that those words, trust but verify. And I think with that, that concludes the presentation. We'd welcome any questions in the last, I think we have 4 minutes. Carrie, we did better. We actually left some time for questions this time. We'd welcome the opportunity to answer any questions you have. Yeah, otherwise, you can email us, email your Sikich rep with questions. We're happy to answer them and provide you more examples. We can provide you some work programs, resources to help you take those first or second steps. And I promise the QR code. So there's a QR code to my LinkedIn profile and Carrie's once again. If this was interesting and you want to connect with me, please do so. If you didn't find it interesting, just don't do anything. I ask you not throw tomatoes at me. And, okay, moderator, I think we pass it back to you.
All right.
Great. Lauren,
thanks so much, Steve and Carrie. We do have just a few minutes here, and so, you know, I guess I'd just like to maybe throw it back to give us some examples of maybe some more examples of some projects that you've done that maybe are deeper dives into reviewing internal controls. Say you're an organization that doesn't really need, you know, full-blown internal audit. You don't have an internal audit, you know, department. What are some ways that your team can, you know, assist with, you know, special projects?
So there's a couple of ways. Really, the first thing is, where do you start? We've mentioned the general controls assessment. I would say the first thing to do that is really to get people in a room and start talking about risk and identifying the critical risks of the university. Once we've come to a conclusion on risk, and you know, it can be really as simple as a conversation. But you want to have multiple people from multiple disciplines, multiple responsibilities. And then we can put together a scope of what that general controls assessment should look like, what areas of the institution we should be looking at, or you should be looking at, and then really walk through and at a granular level, if it's I don't know, if it's student safety, what are the 15 things we're doing to make sure we keep our students safe? Are we really doing them? Are they effective? So that's the most basic area where I would say to start. You got to get a general sense. Once you have the general sense of the institution and you've taken those steps, then you can go into other areas. But I think that is a great first step. I mean, there is never a project has not been a project that we've done where there hasn't been something that's been overlooked by management in a control or a procedure. There hasn't been a risk that there hasn't been a project where we've not identified an unmitigated risk. That's a double negative. I don't know if that makes sense.
That makes sense.
So, Carrie, what else there that I should have added?
I just kind of want to add on a little bit about the general controls assessment. We rattled off a bunch of different areas. Again, starting with that risk assessment, it might be, you know what, guys, I don't need you to look at this, but I really need you to look at this. So it can be as focused or as wide as any institution or organization needs. I just want to kind of add on that. Of course, then also if there's something possibly went awry and an investigation is necessary, and internally they may not have, within the institution, they may not have the resources. Just wanted to mention that. We've definitely come in where something doesn't look or smell or feel right, or we got this report through the hotline in an investigation. It sounds like such a bad word, investigation, but it's really just digging in and finding out what happened. We also do that.
Mm-hmm. Policies and procedures, that's another easy way to start, separate from this, right? So like I said, a lot of times they're outdated or non-existent. I probably at least once a day talk about institutional knowledge, and it's great having an employee that's a long-standing employee that knows everything. But if it's not documented, that employee walks away, you're toast. So let's get that institutional knowledge on a piece of paper somewhere and store it somewhere secure and where other people have access to it. That's one other thing I was thinking about.
Yeah, a lot of times people just don't, I know we're running out of time or out of time, but people don't have that, within institutions don't have the time to do that stuff. So that's what we do. It's important, but it falls down the list. I've seen that time and time again. So that's what we do.
Mm-hmm. Yeah, it goes back to that other, it goes back to that other example I already gave where they knew they had deficiencies in their payables function. They knew it, but they were so busy, they ignored it for 2 years.
Yeah.
So don't ignore stuff. Take action.
Well, thank you so much, Steve and Carrie. Very, very informative. I definitely learned some new things this morning as well. So thank you so much.
All right, thank you. We'll kick off our GAAP update. And as Lauren mentioned, today's presenters, I'm Jennifer Kasakia. I'm a director here at Sikich. Ellen will be covering the GAAP update with me. And then as Lauren mentioned, later on, we'll have Ray to talk about our compliance update. So I think we can skip past the agenda and get right into our first upcoming standard, which is the current expected credit loss standard, also referred to as CECL. So for background, current GAAP follows the incurred loss methodology of estimating the allowance for doubtful accounts, which requires waiting until losses are probable to recognize a loss. FASB issued ASU 2016-13 and various amendments that were codified into Accounting Standards Codification, or ASC, Topic 326, to update the current incurred loss methodology of recognizing bad debt expense. Topic 326 provides guidance on measuring expected credit losses on financial assets measured at amortized cost. The current expected credit loss, or CECL model, requires the immediate recognition of expected credit losses over the life of the financial assets within the scope of CECL. So it changes the current GAAP from an incurred loss methodology to an expected credit loss methodology. The allowance for doubtful accounts will now be referred to as the allowance for credit losses, and bad debt expense will now be referred to as credit loss expense. Prior to the adoption of CECL, bad debt expense was only recorded when it was probable that an amount was uncollectible. Users of financial statements were using their own forward-looking information to make their own assessments about the allowance based on their own expectations. Financial institutions were also frustrated they could not record credit losses until they were probable. So they expected them, but were not able to record them timely. So the main objective of CECL is to provide financial statement users with more timely and decision useful information. Under CECL, the expected credit loss is recorded at the time of initial recognition of the financial asset for all expected losses over the life of the financial asset. In calendar year 2023 year ends and 2024 fiscal year ends, we'll be implementing this standard. So who and what is affected? What's in scope? Trade receivables, loans receivable, held to maturity debt securities, receivables from repurchase agreements, net investments in sales type and direct financing leases, reinsurance receivables, financial guarantees, and purchased credit deteriorated assets recorded at amortized cost. What's not in scope? Investments at fair value with changes in fair value reported through the change in net assets, available for sale debt securities, loans receivable that are held for sale, contributions receivable, so that would include your promises to give or pledges receivable, loans and receivables between entities under common control, operating lease receivables, equity method investments, and derivatives. The main provisions of CECL include measuring credit losses using historical experience, current conditions, and reasonable and supportable forecasts. Management should record the expected lifetime credit losses for assets within the scope of CECL through the allowance for credit losses account. The financial statements should therefore reflect the net amount expected to be collected on recognized assets. There is no threshold for recognition, so all expected credit losses are recorded on day one, resulting in credit loss expense being recorded more timely. An allowance for credit losses is now required even if the risk is remote. Therefore, not-for-profits that did not previously record an allowance for doubtful accounts may now need to record an allowance for credit losses. There may be some limited instances where there could be zero expected credit loss, such as on certain government receivables, but generally not-for-profits will be more likely than not to need an allowance for credit losses. Part of this reason is because the expected credit loss methodology now needs to be applied to all balances, including those that are still current. So under historical GAAP, management may have only provided for an allowance for doubtful accounts for accounts that were over a certain age. Now under CECL, the methodology has to be applied to all of the balances. CECL does add some complexity to the estimate. Under legacy GAAP, organizations base their allowance primarily on historical experience, but CECL now requires not only that historical experience, but also current conditions and reasonable and supportable forecasts have to be part of that estimate. So possible estimation approaches. The good news is CECL does not specify a specific estimation approach to estimate the allowance for credit losses. So not-for-profits can continue to use their current model. However, they may need to make some adjustments to that model to comply with CECL. CECL does require the not-for-profit to measure expected credit losses on a collective or portfolio basis when there are similar risk characteristics shared among multiple assets within the scope of CECL. If a certain asset does not share similar risk characteristics, expected credit losses may be measured at the individual asset level. And Topic 6 does provide a list of risk characteristics that may be used to pool assets. So what is the practical effect of this? How might CECL affect trade receivables, student loans, or notes receivable? So first off, management needs to consider reasonable and supportable forecasts over the life of the asset that is subject to CECL. Depending on the length of the term of student loans or notes receivable, management may not be able to develop a reasonable and supportable forecast over the entire life of the receivable. Ellen, can we go back one slide, please? There we go. In that case, if management can't estimate the reasonable and supportable forecast over the entire life of the receivable, they should use the reasonable and supportable forecast over the period where they're able to develop an estimate, but then you're able to revert back to historical loss information for the remaining period. However, not-for-profits cannot make estimates of credit losses based solely on historical data. They are required to develop some sort of forecast. Now, topic 326 does not specify how much data management must take into consideration to develop the forecasts, but it does provide some guidance. Not-for-profits may look to internal and/or external data and should consider the organization's environment, factors specific to the borrower, as well as prepayments. Likewise, the guidance does not specify how much data you need to look at. It doesn't mandate that the organization use external data. Try to use data that is readily available and is observable over a period of time so that there's not major swings in the methodology over time. So for instance, some internal data that could be used to develop the estimate might be changes in composition of the aging category. So is the portfolio getting older compared to historical data where the allowance might need to be increased because receivables are trending older? Maybe you use drop rates or default rates as some of the internal data that could impact future collections. External data used may include inflation, unemployment, or job placement rates. And as an auditor, of course, I would say document the methodology used and that your data that you're using should be retained to support the reasonable and supportable forecasts. Likewise, have the documentation of the historical collection available to support that part of your estimate. All right, now we can go to transition. So again, CECL is effective for all not-for-profits for fiscal years beginning after December 15th, 2022. So starting calendar year 2023. And the CECL guidance should be applied using a modified retrospective approach. So the not-for-profit will recognize the cumulative effect of adopting the standard as an adjustment to beginning net assets in the period of adoption. The presentation in the financial statements is similar to current GAAP, except for the terminology. The allowance for doubtful accounts changes to allowance for credit losses, and bad debt expense changes to credit loss expense. CECL does require disclosure of management's policy and the methodology for developing the estimate of expected credit losses. So whatever methodology is used is going to end up in the notes to your financial statements. And then topic 326 also requires a roll forward of the allowance for credit losses. So your beginning allowance, your write-offs, your recoveries, ending credit losses. So if your accounting system isn't currently tracking this information in order to provide that roll forward of the allowance for credit losses, you'll want to make sure that you have some mechanism to track that during the year. All right, so that takes us through CECL and into reference rate reform. I'm not going to spend a lot of time on this one because LIBOR has already ceased to be published, so most not-for-profits have already amended their contracts that reference LIBOR. However, for those who have not, there is still time. For not-for-profits with debt agreements or swap agreements that refer to LIBOR, there's targeted relief available to change those contracts until December 31st, 2024. Why might you want to do that? This might be a good time to revisit debt covenant definitions that may not incorporate changes resulting from topic 842, the lease standard. And if you don't get these documents amended by December 31st, 2024, you miss out on the optional relief, which assumes that it's a continuation of a contract and you don't have to remeasure or reassess the debt. So good idea to get those agreements modified now. All right. Next, I would like to just spend a couple minutes on the lease standard. I realize that the majority of not-for-profits have implemented topic 842, but during this implementation period, some common errors have been noted. So starting with the statement of financial position, The majority of the errors that we're seeing in the first wave of implementation related to how the right of use assets and lease liabilities were presented in the statement of financial position, particularly with respect to proper bifurcation between operating and finance lease right of use assets and operating and finance lease liabilities. And then the order of liquidity, that one got missed. Sometimes, you add a asset or liability to the respective sections in the statement of financial position and aren't always thinking about where it goes in order of liquidity or in a classified statement of financial position between current and non-current assets. So that was, the presentation was mostly in those areas where we saw the common errors. In terms of other implementation issues, for those not-for-profits who have not yet implemented Topic 842, common errors we saw in the period of adoption are listed here. I'm not going to read off every one, but those not-for-profits who have already implemented Topic 842, to the extent that any of your lease accounting policy disclosures were included in your implementation footnote or your implementation disclosures, make sure to pull those out and retain those disclosures that are applicable on a go-forward basis. So if you didn't have a separate lease accounting policy footnote and everything was combined into your implementation policy, you want to make sure you retain that lease, the required lease accounting policies. On the statement of cash flows, the most common error we saw in implementing Topic 842 was organizations tried to present the change in the right of use assets and the change in the lease liabilities as increases or decreases in the operating section, the same way you might present the change in accounts receivable and accounts payable. So this was particularly evident in the case of financing leases. So I've listed the different financing, operating, and investing sections where certain payments belong here. So you have that as reference. So just make sure that when you look at the statement of cash flows, the cash flows are going into the proper section. For disclosures, the most common error involving disclosures was missing required elements of the disclosures. Often missed were the disclosure of short-term lease expense and variable lease expense. And for new leases entered into the current year, the acquisition of right of use assets in exchange for lease liabilities should be reported as a non-cash transaction, either on the face of the statement of cash flows or in the notes to the financial statements. Some other various missing disclosures were listed here, but I think that pretty much covers the bases and leases. And next, I will turn it over to Ellen to continue our discussion on common errors.
Okay, thank you, Jennifer. So again, I think just with where we're at, there's not a lot of exciting and upcoming guidance to go through. So now we're going to kind of do a look back and just at common errors that that we're seeing broken out by financial statement. So this is a refresher for everyone. And I'll just say up front, I don't think we'll be able to get through all the slides. I may flip a couple, but I wanted to include them all as it's a lot of great information, again, just to make sure that you're identifying these and avoiding these errors. So we'll just start with the statement of financial position. Again, this one, a common error that you want to avoid is really to ensure that your statement of financial position has your assets sequenced according to their nearness of conversion to cash and your liabilities according to the nearness of their maturity and resulting use of cash. So you could also classify your assets and liabilities as current and non-current, and then disclose in the notes to the financial statements any additional relevant information about the liquidity or maturity of assets or liabilities, including the restrictions on the use of those assets. And there's some factors affecting the liquidity just to make sure that you're sequencing these appropriately. So first, of course, is donor imposed restrictions. So those would be your assets of donor restricted endowments, assets for purchase of long-lived assets, board designations such as your quasi-endowment funds or reserves for special purposes that the board has designated, and then also any legal or contractual restrictions, sinking funds for retirement of debt, or again, any other contractual requirements that you have. So some things that you want to keep in mind here would be first that cash and cash equivalents of perpetual endowment funds held until a suitable investment is purchased should not be included with your operating cash. And I have an example of that coming up. So you really need to not just look at presenting cash, in total, but really bifurcating based on liquidity. So that would also be another with cash and cash equivalents restricted by donors to an investment in land, buildings, or other PPE. That should also be bifurcated. And similarly, investments of endowment funds and split interest gifts should not be combined with operating investments. And lastly, board designated amounts should also be segregated. So this is just kind of a high level. I'm just looking at assets, and actually this should just be assets, not all current, but you can see where cash, your operating cash comes first in order, and then you would really be bifurcating any cash restricted by your donor, restricted for investment, or if it's to be held for purchase of PP&E. And then investments restricted to endowments, of course, is your most illiquid, so that's at the bottom. You can also add additional disclosures to reconcile these amounts, to show total investments for your footnotes or whatnot. Again, anything that is useful to the reader of the financial statements, but you just really want to make sure that you're not just presenting line items in total, but that you're really bifurcating them based on their liquidity. For receivables on the statement of financial position. So similarly, you also want to bifurcate receivables under 605 from 606. So problems we see here a lot are related to the timing of recognition and the valuation. You want to recognize the promises to give when the promise is received, but you really want to make sure that that's a valid and enforceable promise. So you don't recognize intentions to give. If there are really any wiggle room in an agreement with a donor, I plan to give, I hope to give. There's also even been instances where pledge cards say that the pledge is not legally enforceable and is not a promise to give. So you would not want to recognize those. Again, even though you might have it in the back of your mind that that could be coming, that's not following GAAP guidance. You also want to recognize only the unconditional promises. So for your federal cost reimbursement grants, those are typically conditional upon spending for a particular purpose following the very specific grant guidelines. So for example, it's necessary to spend $1 towards that restriction in order to recognize that dollar of revenue. Similarly, matching grants require the not-for-profit to raise a certain amount of contributions from other sources before the donor is obligated to give his or her promise. So if that promise is conditional upon a match, you would only recognize that when the condition is met. So really when that match has been achieved. And you, again, only recognize when they're substantially met. For promises, measure at the net realizable value if it's due within 1 year, and also make sure you're measuring at the fair value or the present value of the expected cash flows. We would like to refer to appendix, I think it's chapter 5 of the not-for-profit guide, that gives you some further information on how to measure the promises to give using the present value techniques. If the promises to give are not measured using the present value techniques, they're typically overstated because the discount is not recognized. So you want to make sure that you're assessing that discount, especially as new gifts are coming in. And as far as liabilities, some common errors, debt issuance costs should be subtracted from the carrying amount of the debt and not as a deferred charge or a prepaid. Funds held for others should be segregated. And then, of course, incorrectly using deferred revenue, which is for exchange transactions for topic 606 versus refundable advances for your contributions under 958. So you want to make sure that you're using the correct, if it's deferred revenue for an exchange or a refundable advance for the others. And then for net assets, for your board designated net assets. Again, those are subject to the self-imposed limits set by the governing board for your programs or investments or other uses. The designation and decisions for appropriation may be delegated to management. You also may want to disclose the nature and amounts on the face of the statement or in the notes. You also want to consider, are there sufficient assets available to designate? So you want to make sure when you have your board designations and your with donor restrictions that you have assets that are clearly designated for those and you're not underutilizing those. So we'll move next to the statement of activities. So here's one that I think we've seen where you want to follow your accounting policy. So we'll go through these two options. So again, option 1 is your policy where you're showing an increase to net assets with donor restrictions and in net assets released from restrictions. Option 2 is if you've elected this policy, you show immediately as without donor restrictions if you have met those restrictions within the same period. And you can elect a separate policy for contributions with donor restrictions that were initially conditional. So you can have a separate policy for the conditional versus non-conditional or unconditional. You must elect a consistent policy for investment return with donor restrictions that are met in the same period as well. And so here's an example. So above, the first is option 1. So here you can see, all of the kind of grossed up restricted activity flowing through so that you see the net is an increase to with donor restrictions of $7,450. And so down in option 2, you can see where all of the net release policy, if they've been met in that period, is going straight to without donor restrictions. And it's really just showing the one line item where the restriction was not met. So you're just showing the $7,450 in the with donor restrictions column. So again, you just want to make sure that you're being consistent, that your policy is disclosed in the footnotes and that that's what you're following in your statements. And similarly, we've also seen some where there's a failure to recognize contributions of non-cash gifts. And this was standard, the newer standard a couple years ago as well. If there's difficulty in measuring a gift, there's not a reason for not recognizing it. So GAAP has been fairly clear that management needs to make a reasonable estimate to recognize the gift. You can't just say, oh, we can't get a value, so we don't feel comfortable recognizing that. It's also sometimes when you're reviewing financial statements, you say, how do I know that a non-cash gift exists, but maybe wasn't recognized? There's sometimes policies in your footnotes that might say something like non-cash gifts were not recognized because the criteria for recognition have not been met. And that's really only applicable to contributed services where you have recognition criteria to meet there. So if it's not contributed services, you should really be recognizing that gift. And then the policy note also, if we see something that says non-cash gifts were not recognized because no objective basis for measurement was available. So again, that's you have to make your reasonable estimate to record those non-cash gifts. Also separately reporting the contributed non-financial assets, if they are material to your financial statements, is required. So you can no longer group those within contributions. Those have to be bifurcated on your statements. You also want to consider special events, as often those are triggers for non-cash gifts related to auctions or other fundraisers. So still on the statement of activities, grants, sometimes there's errors may result if the grants are improperly determined to be contribution or exchange. So you have to go through that through your steps to really identify what guidance you're following. Is this a contribution or an exchange grant? FASB 606 requires those performance obligations to be satisfied to recognize the revenue from grants if they're exchanged. Revenue shouldn't be recognized, of course, if the conditions have not been met. So cost reimbursement grants, as I mentioned already, require those applicable expenditures. Matching grants require those gifts, and et cetera. Possibility of refund upon audit would be a contingent liability. So if you've already received funds up front, you want to disclose if it's reasonably possible and recognize if probable. So again, if you have something, a contingent liability that's reasonably possible, that would just be a footnote disclosure. Again, common errors we already mentioned, not following the policies. If net assets released from restrictions don't net to zero, missing required subtotals, or also improperly excluding gain or loss on disposal of property from the operating measure. And now this is still statement of activities, but I'm going to jump back into, I'll go into the expenses a little bit more on that section. But again, on the statement of activities, you can present a mixture of natural and functional expense classifications. Expenses are decreases in net assets without donor restrictions. Of course, by nature, expenses do not have donor restrictions. Losses may be reported as decreases in net assets with donor restrictions or with donor restrictions when applicable. And then also losses, for example, on the sale of property equipment do not belong in expenses. Other common errors would be, again, the inappropriate accounting for investment return, including gains and losses as without donor restrictions when there are donor imposed restrictions. And that's something that I'll talk about later with the footnotes. You always want to make sure that your investment return with donor restrictions, especially as related to an endowment, that you can reconcile that to your footnote disclosure. Or improperly utilizing net assets without donor restrictions before releasing available net assets with donor restrictions. This is sometimes referred to as squirreling away, where you have available cash, you use it, you're kind of keeping your reserved, your restricted funds saved until you really need them, but you really need to release those if you're expending something towards that purpose. And then also improperly releasing net assets with donor restrictions. They're subject to both a time and purpose restriction. You need to meet both of those. Implying time restrictions on gifts of long-lived assets or cash to construct long-lived assets beyond the date the assets are placed in service. So again, it's even as you're building something towards this restriction, you cannot release that full restriction until the asset's placed in service. So even if you're making progress, you have to hold off on releasing that. Also improperly releasing restrictions on gifts of long-lived assets as construction is occurring. Okay, so that was that. And then reporting revenues from exchange transactions as increases in net assets with donor restrictions, so I already mentioned. Try to get through this quickly. I've got 10 minutes before we hand it to Ray. The analysis of expenses by nature and function, I think this is kind of high level, but again, you have different options here, on how you're allocating the direct, salary-based, square footage, or really other rational and systematic basis that works best for your school. Just as long as it's consistent, and you want to make sure that you've also properly disclosed what expenses are being allocated on what basis, and that's clear. So these are, again, some common areas. I'm going to skip through that. One would be you want to make sure occupancy facilities costs are being, the error would be if it was presented as a separate program. You want, again, all the costs to be allocated amongst the programs that are using that space. Also, sometimes we'll see inadequate or improper natural expense classifications, or expenses that should be in management in general that have been allocated out. So for example, your audit fee should always be in management in general. Really, expenses also that are allocated without an apparently reasonable methodology. So if you just see something split 50-50 and it's not clear, you may need to revisit your method for that. Moving on to the statement of cash flows. Again, you're required to present the change in cash, cash equivalents, restricted cash, and restricted cash equivalents. I think it's important to note that the statement of cash flows actually uses restricted cash with a broader meaning than donor restrictions. So beyond just your donor restriction cash, you would also want to include things like deposits, escrow, debt service, charitable trusts. So again, just a broader purpose, and you would want to reconcile to all of the restricted cash there. Another, just some common errors, failing to properly report operating adjustments, so such as bad debt expense, gain loss on the disposition of fixed assets. So that should be, again, presented up in the operating adjustments and the proceeds of sale and the investing cash flow section versus those being net just as the proceeds. Contribution portion of a new split interest agreement or a change in the value of split interest obligations should also be in the operating adjustments. So contributions for long-term investments or fixed assets should also be in the adjustment section, and then also reflected in the financing activity section. The amounts will differ if there are contributions receivable related to those, of course, so just make sure that those are being appropriately presented there in both sections. For your investing activities, purchases of fixed assets is an accrual basis purchase rather than the true cash outflows, right? So those would be reconciled with your accounts payable up above, or netting purchases, abandonments, or sales with purchases of your fixed assets. Omitting investing cash inflow for sales proceeds from long-lived assets, or again, just more where you're netting purchases and sales, you really want to have all of those numbers presented solely. For financing activities, some common errors. Proceeds from issuance of debt should be presented separately from payments on debt, so those should be presented gross. Again, you kind of want to keep things gross on your statement of cash flows. Draws and payments of line of credit are netted versus gross as well, and the debt issuance costs are a financing cash outflow and not an adjustment. Also, if you have non-cash activity, the investing and financing activities, so you want to make sure, again, that the non-cash gifts are being reflected in your statement of cash flows appropriately. failing to, I guess you want to make sure that you're adjusting for those purchases of fixed assets if you had a non-cash donation. And lastly, some supplemental cash flows. Common errors would be missing the required disclosures on the face, so such as income taxes paid or interest paid. You also want to make sure you're not reporting the expense and are actually reflecting the cash that was paid. And we have another code word. Code word 5 of 6 is 121. I'm going to keep moving so we can get to the compliance section. So I'll be finishing up with some common errors in the notes to the financial statements. And again, I might flip through some of these, but this is just some great information. So we wanted to include all of this for the handout. So often missed disclosures, again, back to the operating measure. So if you have an operating measure in your statement of activities, it might not be apparent if you have similar line items both above and below as operating and non-operating. So there you really want to make sure that it's clear to the user of the financial statement. For example, if you have grants and contributions in the operating and then the non-operating, what differentiates those? What made you pull that amount out as non-operating? So make sure that's disclosed. Or you could also have better titles of your line items there to help differentiate, were these certain bequests or something that you've pulled out. And also if you're presenting the prior year summarized, make sure you have those disclosures. And also disclosing the use of estimates that are made by management. Again, we already mentioned a lot of these accounting policies, the same year election. You can have those separate elections for the conditional and unconditional gifts. Another one we've seen from 606 would be not including your beginning balances of the contract assets and liabilities for each year presented, or the measure of progress, the input-output methods for our overtime revenue streams. Often missed disclosures also would include your concentrations of risk, outstanding purchase commitments. So again, if you're under construction, you want to make sure any commitments that you've made but that have not maybe been completed yet are disclosed, as well as related party transactions like board contributions. And then also for your endowments, the disclosure of the underwater endowment funds. That's something that you want to make sure you have appropriately disclosed. This slide is about if there's a negative amount of available financial resources. So I'm just going to skip over here again. This is something you would want to revisit if you're running into that, make sure that it's correct, but then also check for other resources available and make sure you have all of your qualitative information disclosed that you would also use for liquidity. Accounts and notes receivable, this also has some required disclosures, so just leave that there, or your investment disclosures, again, inconsistencies in classifying investments held at a community foundation as level 2 or level 3. Sometimes that's something that we've seen, and really the classification is based on the college's ability to receive the assets in the community foundation or trust, independent of whether there's a purpose or permanent restriction attached to the use. So it's important to differentiate between those. And then this is an important one. I think that the importance of the net assets section is often overlooked. I think it's one of the most useful in providing information about the health and financial flexibility of the school to continue in the future. And sometimes it's missing some crucial points there. So again, you want to make sure you have your composition of net assets there, emphasis on whether it's a specified purpose, specified time, split interest gifts, or if it's restricted in perpetuity. And then for those with specified purposes in perpetual, a best practice would be to use the same programs as the statements of activity, and also to include a subtotal of net assets with donor restrictions related to the endowments to tie to the endowment note. So it's nice to see in your net asset footnote, because they may not all be restricted in perpetuity. If you have a term endowment, to tie that out so you can see what your total endowment is. And then I've already mentioned, ensuring your investment return and your endowment disclosure reconciles to your investment return with donor restrictions on your statement of activities. Gifts in kind, I think we already mentioned that, failure to recognize with appropriate disclosure, the disclosures requiring the qualitative and quantitative disclosures, and remembering that contributed services are non-financial assets. This is an example of the functional expense policy disclosure. Again, just to make sure that you're following your methodology and that you've listed out the name of the line item on the statement of functional expenses in this footnote so that it's clear which method is used for each of those lines if it's not a direct. Okay, so for our final review, again, make sure you have, you can ask yourself, have new accounting policies adopted been appropriately disclosed? Have the required accounting policies been included, and are they consistent with your statements? Is there a note for each significant line item? Review each line item associated with the notes. If items are reported net, is that offset allowed? Again, make sure that's not something that you need to be grossing up. Make sure you're revisiting your disclosures every year, identifying any relationships and making sure that things are tying together as they should. And then lastly, it's helpful to obtain a disclosure checklist and fill it out and make sure that you really are understanding that. And with that, I am going to hand it over to Ray, who is going to keep you updated on all things with institutional eligibility.
Okay, hopefully everybody can see my screen. We're going to go through the institutional eligibility and talk about some various topics. Obviously, there's way too many topics to talk about in a half hour, but we want to highlight a few of those. So some of the key takeaways, we're going to talk about maintaining, obviously, things like the eligibility and certification report, the ECAR, the program participation report, and also talk about some consumer information as far as what's required to communicate with prospective and current students. Then finally, we'll talk about make sure you're complying with the more recent provisions of the Graham-Leach-Bliley Act. First of all, for institutional eligibility, one thing obviously you need to keep in mind is making sure all your state licensing and accreditation's up to date. Typically, having calendar reminders is helpful in this area. I know it's very time consuming, the accreditation process, and sometimes it's going on the same time as an audit. I always hear from the institution sometimes that the audit's going on the same time as accreditation, so it's very time consuming. So making sure you have appropriate planning for that's important. As far as the ECAR itself, it includes some of the key information for institutions, including what programs the school participates in, whether it's the Pell direct loan. Not every school participates in direct loan, SEOG, work study, and various programs. There has to be an academic calendar. Is the institution on a semester basis or trimester? And then, of course, what programs are offered. If it's a non-degree programs, associate's degree, bachelor's or master's degrees. In addition, that ECAR would obviously include the first time it's been initially approved, but also that typically an ECAR is good for 6 years, and accreditation information has to be up to date as well, including state authorization. Keep in mind, if your school has campuses that cross state lines, you're going to have, if those satellite campuses are in different states, make sure your authorization is included in all the states. What's key to note in the official section, there's key information on key officials within that section, including the president, financial aid director, vice president of finance, and of course, additional locations as well. Schools that have locations where they have satellite campuses or other multiple campuses, if at least 50% of that educational program is offered at that branch, it needs to be located on the ECAR. And what typical auditors do, and of course Department of Education would do as well, they're going to look at your website and they're going to see if there's institutions that are included on the website but not included on the ECAR, which could cause issues. And what's important about this slide is, and we're going to talk about on the next slide actually, is if there's changes to any of these things, if you add a campus, if your president is retiring and you replace the financial aid director, those key things have to be communicated and followed up on. And notification has to be done within 10 days. So the other thing too, educational programs, I've seen schools that added new programs but didn't communicate those programs to the Department of Education, so it was not included on the ECAR. They still administered financial aid to those programs, which could cause obviously issues with the Department of Education. The program participation agreement is the next document we'll talk about. That's really your contract with the U.S. Department of Education. That was back in beginning the creation of Title IV back in 1965. And what that PPA applies to, it includes all your locations. that are listed on the e-card, what programs, as I mentioned, are participating in, whether it's Pell, direct loans, SEOG, work study. There's various certifications on the PPA, the first two. One is having a drug abuse prevention program, and then the next is complying with campus security policy and campus crime statistics. We'll dive into that a little bit further in this presentation. Some other compliance requirements under the PPA, Title VI, Title IX, FERPA, Age Discrimination Act. The GLBA we'll talk about a little bit later in the presentation, but these are some key elements that are, you're promising to participate in the PPA, you have to adhere to all these different compliance requirements. Other general provisions, one of them is minimizing the time that you disperse aid to students. So when you request funds from the department, you can't hold on to those funds for definite periods of time. You have to disperse them to the students as soon as possible. Institutions can't charge students for processing application for financial aid, so there's no charge to do a FAFSA for schools. The last bullet point I want to make sure I emphasize on this slide is bonuses are allowed to be paid to individuals within certain parts of the campus, of course, your registrar, your admissions department. However, those bonuses can't be tied into secure enrollment. So if everybody gets a bonus in that department, that's one thing, but if bonuses are specifically tied to securing a certain number of enrollment, that would be not allowed by the department. A couple other areas, lobbying is obviously disallowed with federal funds, and having a drug-free workplace is also something that has to be in place for an institution that you're agreeing to in your PPA. Establishment of a drug awareness program is required, and that including what the dangers are, what your policy is, what available counseling is there, and what are the penalties imposed for violating that policy. One key thing to note in this slide too is if an employee has been convicted of a criminal charge, they have 5 days to notify the institution. So your institution should be notified within 5 days, and why that's important, we'll see actually on the next slide, because the institution then in turn has 10 days to notify the Department of Education about a drug conviction. So that communication is very important to make sure you're adhering to those days. And then finally, after that, the school has to take action within 30 days with that employee. Well, that action could include suspension. Maybe if it's a repeat offender, it could be termination of that employee, and also potentially require an employee to participate in some sort of a drug rehabilitation program. Other things as part of the PPA, institutions can't be suspended or debarred, and of course couldn't be convicted of a certain types of felony, which is included in on this slide. I mentioned the drug and alcohol abuse prevention program. This program should be distributed both to employees and students. Remember, it's both are affected. Being an institution, you have employees, and of course you have the students. They both have to be aware of what the programs are, what the school prohibits, what are based on state and federal law, and also what are the health risks associated with these drugs and abuse of alcohol. All that has to be communicated. Also descriptions of what's available at the school, whether it's counseling, treatment, rehabilitation, all those programs that are available, the programs of students has to be specified. And then of course, a very clear statement about what are the disciplinary actions or sanctions that could take place should a student or an employee be convicted of a drug felony, and also making sure that program is effective, at least doing a review of it, at least biannual, to be sure that that is an effective program, or you may have to make modifications to your program. Next, we're going to get into some required consumer information. As I mentioned, there's so much consumer information that should be communicated to students. We can't spend all day talking about this topic, but I did choose one area. And some other areas that obviously I'm not going to be talking about would be graduation rates, job placement rates, those things that are really required consumer information. What consumer information is really entitled for is allowing a student to have information available to them that they can make informed decisions about attending a certain institution. I will talk about the Clarity Act. That's the one topic I decided to include as our consumer information, and want to talk a little bit about that as well. We have several slides that'll cover the Clarity Act. Most of you are aware of what that Clarity Act's about. Back in 1965, it was enacted, but in 1990, they passed a Crime Awareness and Campus Security Act. Not till 98, it was actually renamed in the Clarity Act in memory of a student who was unfortunately murdered in her dorm. In 2013, there was a new modification to it. The Violence Against Women Reauthorization Act, or VAWA, was added and added some additional amendments to the Clarity Act, which we'll talk about. And the next thing I want to talk about, what are the potential consequences, of violations? Schools that have been in the news, we'll see it on the next slide. There are some unfortunate situations where schools have incurred very, very large fines because of not following policies or not reporting properly with the Clarity Act. Fines could be up to $35,000 per violation, and potentially, obviously, the outcomes could be they could suspend your Title IV financial aid and not be able to participate in the Title IV program. So it obviously has some very, very strong impacts on the institutions. Some of the ones in the news in the last 10 years, Baylor was fined $461,000. That was relatively small compared to some of these other ones. UC Berkeley, North Carolina, you can see there. The two largest ones in history so far, in 2019, Michigan State, that's still the largest Clarity Act fine ever levied by the Department of Education that involved sexual violence claims against a former employee, which was a university doctor. In 2016, Penn State had a $2.4 million fine, obviously with other things involved as well. In the actual financial state handbook, there's actually a Clarity Act appendix that the schools have to follow. And some of the basics information that's included in that appendix include disclosing missing student information or missing students, notification, keeping a daily crime log, publishing an annual security report, which we'll talk about, submitting crime and fire statistics, and also fire safety. Part one of the Clarity Act really talks about disclosing the annual security report. That has to be done for the three most recently completed calendar years. Now, this report's due October 1st, so your calendar years are going to be the preceding 3 years. And what that includes is there were some actual additional requirements. I mentioned that 2013 with the new passing of the VAWA Act. It added some additional requirements to report on hate crimes, domestic violence, dating violence, and stalking. They were added to the list of already crimes that had to be reported. And any crime that's reported to either your local police agencies, if a particular institution doesn't have their own campus security and they have just a local police, but if they have campus security, any crimes reported to either that occurred on campus need to be included in your report. So, and that's what actually some of those fines that we saw in the previous slide, how they came to be. There was lack of reporting between what was reported to local police and what ended up in the campus security report. We'll talk about really what on campus is and the various different things with the Clarity Act very, very soon on the next slide. Clarity geography, and that's very important because institutions have to report crimes by locations in 3 categories. One is on campus, the second is non-campus building or property, and the third is public property. So you have to distinguish between the 3 of them. Now, on campus is really defined as a building or property owned or controlled by the institution within the same reasonably contiguous geographic area. And that building or property that is reasonably within that geographic area, or this definition, is owned by the institution, but may be controlled by another person. So I'll give you examples of both. Obviously, in a student center, that's going to be on campus. But also keep in mind if institution outsources food services or bookstore to an outside vendor. For example, in my daughter's freshman dorm, there was a Subway at the bottom floor, and that Subway, although is owned by the institution, but it's not controlled there. Any crime that was committed in that retail environment would have to be reported as well as on campus, because that place resides on campus. It's part of that contiguous geographic area. So that's the definition of on campus. Even though the school doesn't control that, the subway, they don't hire people and control the working there of that particular example, but they would be required to report that. And unfortunately, the Department of Education doesn't really define reasonably contiguous. However, most institutions use the approach, and I would use the approach, if it's on the campus map, on the signs, it would be part of campus. So if that bookstore, that whatever that is, it's on campus. A parking facility is another example. If it's on campus, if that parking facility is noted in your campus map, if I can go online and see that on your campus map, I would call that part of your on-campus geography. So non-campus property, what is that? That's really something that's owned or controlled by a student organization officially recognized by the institution, or a building or property controlled by the institution, even though they don't own it, and it's frequented by students. And once again, the Department of Education doesn't define necessarily officially recognized, but the most common would be, and we'll talk about that on the next slide, do they receive financial support from the institution? That kind of defines it right there. An easy example of that would be a fraternity or sorority house, campus bookstore, campus apartment buildings. I know some schools have campus-owned apartment buildings that are, due to overflow, are really part of the actual environment of the campus. So those would be considered in that category of non-campus. And the second part would be something that's owned by someone else potentially, but controlled by the institution. An example of that would be, there could be an off-site summer camp. Maybe there's an institution sponsors a soccer camp that's 2 hours away from the institution. That would be part of non-campus. They don't own it, but they do control the activities on that. So that would be something you'd have to report if there was a crime committed in those areas. That would have to be reported as non-campus. And finally, the last category is public property. That's a little bit more again, defined differently, of course, as well. It's within the same reasonably contiguous geographic area of the institution, but it's going to be things that aren't owned by the institution. The institution doesn't own the sidewalks, they don't own the streets, thoroughfares, maybe even some case the parking facility. It could be the public facility, parking facility could be something that's owned by the city or the municipality that the institution is in. Those situations would be considered public property. Since it's contiguous to the campus, that would be part of the public property. You would have to report that as well. So the elements, what's public property? Well, once obviously it's publicly owned, that's back to the streets, the sidewalks, things like that. It's not owned by the institution. It has to be within, adjacent to the campus and accessible from campus. So clearly, if there's things that aren't, or if it's marked private property next to institution, that would not be part of the Clary campus geography. As we go into the difference between what Clary geography is and Title IX, Title IX is different. The definition of what the geography is for Title IX is different. So for Title IX, if an on-campus event is attended by officially recognized student organizations and a harassment occurs, even though that may not meet the Clery definition, it's going to meet the Title IX definition, because unfortunately Title IX definition has no boundaries. So wherever that incident occurs within the United States, if there's a harassment that occurs, that would have to be reported under as a Title IX violation. Example of that would be if your fraternal organization has a convention and that convention is held out of state, it wouldn't be necessarily in the geography for Clery, but that Title IX violation would be something that the institution would be responsible for. Reporting, I mentioned this annual security report is due every October 1st. It's going to include a bunch of information about campus facilities, including a fire safety report. It's going to have to mention as I mentioned earlier, crime statistics for the 3 prior calendar years, and also policies, procedures for victims on how to report on either obviously in a voluntary and in a confidential basis. The policies this is not all the policies, of course, it's just a list of some of them. What institutions are required is having a policy on alcoholic beverages, underage drinking laws, illegal drugs and how they apply with federal and state drug laws, programs on substance abuse, key number 4 is having prevention, things to try to prevent these things. So becoming aware of what constitutes dating violence, what constitutes domestic violence, sexual assault, stalking. Those things are specifically identified on what's considered in those categories, and information regarding sex offenders, and of course, emergency response and evacuation procedures. That's just the beginning of the list. The next slide is going to be a few more. Policy on missing student notifications. We'll talk about that in a few minutes. Back to the campus crime statistics, policy on security, and then security and then procedures and practices as well. The annual report has to include descriptions of program, how to inform students and employees about the prevention of crime. As I mentioned, prevention is the key. The more you can prevent, obviously, the better it's going to be for the institution and obviously the students and employees attending that institution. What are the programs for security? What are encouraging students to be responsible for their security, and also monitoring activities of non-campus, as I mentioned, for those activities that are held off campus for officially recognized student organizations. What are the policies for that as well? Other policies include possession, use of alcoholic beverages and illegal drugs. Statements that, number 6 is really just stating that both the accused and the accuser have the same rights, and how that disciplinary proceeding will occur is really specified in that policy, and also that both the accused and accuser do have the ability to appeal that institutional disciplinary hearing if should they choose to do so. So really, any institution that has a campus police or security department must maintain a daily crime log. So as I mentioned earlier, any crimes that are reported either to campus police or security, they have to be included in that daily crime log. And then once again, making sure that they have a statement that addresses prevention. As I mentioned, that's a key as well. And making sure that policy and procedures for those offenses contain what are the consequences, what constitutes, as I mentioned, dating violence, domestic violence, sexual assault, stalking. It's going to give definitions of, for example, definitions of what consent is in reference to sexual activity. So it's very important to have that specifically noted in that requirement. And then other things that are included in that document as well is what are the procedures that a victim should follow, how to communicate those procedures. Preserving evidence is very key. How and whom to report that offense to, and then options about how they want to report. They may want to report to the local law enforcement, including campus or local police. They could choose to report it either or both. Also assisting them if the victim chooses to, identify or be anonymous, to decline, if they choose not to notify or report it as well. But you're obviously making sure you're providing, rights of victims as well. And if they want a order of protection, things like that would be included as well. Other things included there would be if the victims want to be change their academic environment, or if they want to move to another dorm, for example, a more safe living environment. That has to be a policy as well. They have to have the ability to do that. They have to have the ability to receive counseling should they need it, whether it's health counseling, mental health counseling, advocacy. All those things should be available to the victim, whether or not they're an on-campus student or even an off-campus student. If they're a commuter, they should have the same rights and privileges to have those services available to them as well. As far as the disciplinary hearing, types of proceedings, how it's determined is up to the school. What are the sanctions, and also would be up to the school as well. Those proceedings, they have to be conducted by trained officials. Two things in number 6 and number 7. One is both the accuser and accuser will have the same opportunities to have others present should they want legal counseling with them. They'd have that right. And then they both have a right to receive the outcome at the same time. And they both have the accused and accuser have the ability to appeal that outcome as well. Any institutions that have on-campus housing, which I assume most of the schools on this call today for on the FASB, but if you have on-campus housing, an annual fire safety report has to be submitted as well. It's going to include your statistics, description of your what are your on-campus housing facilities, how many fire drills you have, and what your policies on electrical appliances. I know certain schools have very strict policies on what you're allowed in your dorms, whether it's different appliances or things that are allowed or disallowed within your dorm. That needs to be in your policy as well. And procedures for evacuation, policies on fire safety and education, things like that all need to be included as well. Fire log, same thing as a crime log. If you have on-campus housing, you have to maintain that. The fire log has to be publicly available 60 days or more. And then that annual security report has that annual fire safety report as well. Next, on missing persons and policies and procedures, the institution, obviously if you have on-campus housing, has to have a policy on how to report a missing person. Usually that's identified as a person missing for 24 hours. And what are the requirements to who to report it to, whether it's the campus security, if they don't have campus security, local law enforcement, and then having a contact person. Who's the person they would contact should an event occur where a student is missing within 24 hours. That person, whether it's a person's parents, a spouse, a significant other, whatever that case is, they need to have that included in the policy as well. As far as having emergency response, evacuation notifications, timely warnings, those have to be included in your policies in Part 3 as well. Making sure you have things like what is a significant emergency or dangerous situation, what's it include, what qualifies for that significant emergency or dangerous situation. Determine who do you notify, what is your community, is it on-campus students. Obviously if you're at more of a commuting school, it's going to have a lot of that commuting school is a different community, of course. And then what's your notification system? Is it through text? Is it through obviously email, text, phone, whatever that is, you have to have your system in place. And then who's responsible for those activities as well. There's some differences between really what constitutes emergency notification versus a timely warning. Typically, emergency notification is something that's significant emergency or dangerous situation that's happening currently. So it's triggered by something that's either occurring on or imminently threatening campus, on campus upon confirmation. Once that situation is confirmed, really it has to be how timely, it has to be immediate. So as soon as a situation of a dangerous situation is out there, that notification has to go out immediately to the students and consumers, whether it's employees, students, or like I said, commuting students as well. The difference between what that is versus a timely warning. Timely warnings typically are something that's occurred already, a crime that it's occurred, but you want to warn a student about a threat. For example, if there's been a rash of assaults in a specific area, that timely warning should go out to let people know that that situation is still ongoing. Maybe that individual, the perpetrator, hasn't been caught or arrested yet, so that's an ongoing threat. So that's something that needs to be, once again, immediately notified. Usually it's going to be something in the Clery geography, as I mentioned, either on campus, non-campus buildings, of course, or public property. And once again, as soon as the information is available, that's what's obviously key. Next, we're going to go into our last code word. So code word 6 of 6, this is obviously for individuals looking to get CPE. The number is 249. Once again, 249. I'll give a little bit of time for those who are just scanning the QR code. Keep in mind, this is for individuals looking to obtain the CPE, hopefully getting some hours in the last few days. So once again, the code word is 249. It's our last code word. So you should have 6 code words for today. And we're going to finish up today with updates to the GLBA, the Graham-Leach-Bliley Act. I know that was something that was some new requirements came out in this past year in 2023. So technically, you had to be in compliance as of June 9th, 2023. So really this was passed back in December of 2021, and it takes a while to the final rule, of course, for increasing safeguarding consumer information, but the effective date was June 9th of 2023. So schools that had junior ends for 2023 had to have this in place already. However, obviously it depends what process you're in. Hopefully you were already compliant, but if you weren't, hopefully this next couple slides will give you a little refresher on what was required with this new requirement. Because basically, if you have I mentioned a program participation agreement, you are also compliant or agreed to comply with the GLBA requirements as well. And it's really, the goal is really protecting both customer and customer information. Keep in mind what a customer is at an institution. It's going to include students that are currently there on campus and also your past students. As long as you have student information in your records, whether it's a past student or not, that's considered still a customer. That's still customer information. So you're protecting the integrity of that information for both current and past. What are the objectives for GLBA? One, obviously, is security and confidentiality of student information. There's a lot of information that's stored at an institution. When you hear about cybersecurity and threats and breaches, the two probably most common areas or industries that are affected are healthcare and higher education, because they just contain so much student information that's out there. So trying to protect that information is obviously of utmost importance. And you're protecting against anticipated threats or hazards, and obviously unauthorized access to that information that could result in substantial harm or inconvenience to a student. That's specified in the codification in the OMB, you can see there. So what was new? What they did, part of this new requirement, they added elements. So for most schools in this webinar today, it's going to be 9 elements. For smaller schools, it's only 7. But that 5,000 is kind of the cutoff for consumers. But as I mentioned, consumers include past and present. So with 5,000, it wouldn't take too long for a school to have over 5,000. So most of institutions in this webinar today are going to have to meet all 9 elements. The first one is on element 1 is having a designated individual responsible to oversee the program, having a person that's really in charge. That's important. That's element 1. The element 2 is probably the more difficult of all these elements, is having a risk assessment on your entire security program and making sure that you could result anything that could result in unauthorized access, alteration, destruction, compromised information. All that stuff needs to be part of your risk assessment program. So really making sure you establish that risk assessment program. That's part of element 2. Element 3 is designing and implementing effective safeguards, because you're going to have those risks. So what are your safeguards to control those risks the best you can? So that's important, is having a plan in place to safeguard those risks that you identified in element 2. Element 4 talks about making sure you regularly test or monitor the effectiveness of safeguards. It's no good to have a safeguard if you don't know it's going to work. So element 4 is really incorporating testing that and monitoring your effectiveness of your safeguards. Element 5 is really providing for the implementation policies to ensure that personnel are able to enact the information security program. So just because you have these safeguards, can you enact them that it's effective, that it's going to control those risks? So that's what's in element 5. Element 6 is really overseeing how the institution will oversee its information system service providers. Often that's outsourced to an outside service provider. So are you monitoring and overseeing their work as well as your outside information service provider? Element 7 is as a result of your monitoring and testing, if there's changes that need to be made because of the results, element 7 states you have to make those changes. So if after you did your monitoring, you did your testing, you felt that there was changes that need to be made because of certain things that didn't meet your expectations, element 7 saying, well, you need to fix them. And finally, the last couple, making sure you're maintaining information. As I mentioned, remember 8 and 9 are only if you have more than 5,000 consumers, but most schools are going to have that. Do you have an incident response plan? If there's been a breach of that information, what is your response plan? So that's part of element 8. And then finally, the last one, element 9, is after you've gathered all this information, you have this information from your risk assessment, your testing, do you report it to those at the institutions that are in control? So does the board or does the cabinet of the president's cabinet, are they aware of your information system and how effective it is? So that has to be done at least annually. I think it's a good best practice to do it multiple times a year, just to know that you let the board know, or the audit committee, or whoever is part of that committee, know that the school was actually doing the proper things in your results for that as well. The last thing is just really the last thing I want to cover. We're running up on the end of time. Is really just stating that all this thing I just mentioned there, it's very specific in the guidance for uniform guidance, that if you're not doing these things, that you are potentially considered not to be administratively capable, and that would result in, of course, a finding as far as your administrative capability, and potentially could end up with a qualified opinion for non-compliance. So it's enacted there. It shows the CFR section that says if you're not in compliance. And with that, I've come to the end. So I appreciate, once again, taking time to listen to us. There you see once again, our information there. Feel free to reach out as far as either Jennifer, Ellen, or myself today. And with that, I'm going to turn it back over to Lauren for some concluding remarks.
Great. Thank you so much, Ray. Just a quick reminder, before leaving for the day, don't forget to check out on Conferences.io and to complete the survey that should pop up when you exit the webinar. Thank you all so much for joining us over these last 3 days. Thank you.